All right, everyone, let's get into it. Today, we are going to do a complete revision of a standard that is an absolute favorite for the examiners, AS20, earnings per share. We're going to break down everything piece by piece and really focus on those tricky little adjustments where students, so often lose marks. So let's just dive right in. But first, let me ask you something. What if I told you that something that happens in 2022 could actually force you to go back and change an answer for a 2021 problem? I mean, think about that for a second. It sounds completely impossible, right? Well, it's not. This is actually a classic ICAI trap in AS20 that we are going to completely take apart today. If you stick with me, you will never, ever fall for it. So picture this. A company has 10 lakh shares out there, and they make a profit of 20 lakhs. Super simple, right? Profit divided by shares, the basic EPS is 2 rupees per share. Easy. But what if, say, halfway through the year, they issue bonus shares? Now, sure, the calculation for the current year gets a little tricky, but the real question, the one that trips people up, is how in the world does this affect last year's EPS, which has already been reported? Let's figure this puzzle out together. Okay, let's get started. We're beginning right at square one to build a really strong foundation. So first question, why do we even have this standard? What's the point? Well, the whole purpose of AS20 really boils down to just one word: standardization. You can think of it like this. It's like a universal recipe. Without it, every company would calculate their EPS a little differently, which would make it totally impossible to compare them. This standard makes sure everyone is on the same page, so you can make a fair apples-to-apples comparison, whether you're looking at two different companies or just one company over several years. All right, let's quickly get our terms straight. Equity shares, preference shares, we all know what those are, but the real game changer here, the term you absolutely have to remember, is potential equity share. Just think of these as, well, shares in waiting. Things like convertible debentures or stock options. They aren't equity shares right now, but they could become them. Honestly, getting this concept is the key to understanding the entire second half of this topic, which is diluted EPS. So make a mental note of this one. Okay, it's time to break down the main formula. We're going to start with the top half, the numerator, which is all about the earnings. So here it is, the heart and soul of basic EPS. Net profit for equity shareholders divided by the weighted average number of shares. Looks simple, doesn't it? Well, not so fast. Both the numerator and the denominator have their own little quirks and traps, and you've got to master both of them to really nail this topic.
Now listen up, because this right here, this is a major exam trap. This is where marks are just lost needlessly. To get the profit that's actually available for the equity shareholders, you have to subtract any preference dividend. But it's not always straightforward. For non-cumulative shares, you only subtract the dividend if it's actually been provided for in the books. But, and this is the important part, for cumulative preference shares, you have to deduct the full dividend for the period, and it doesn't matter if it's been declared or paid or even mentioned. You just deduct it. ICAI absolutely loves to build questions around this one little difference.
So just to recap the numerator, you start with your net profit after tax. You don't have to worry about tax or any extraordinary items that's already taken care of. The one single thing you absolutely have to remember to adjust for is those preference dividends using that critical cumulative versus non-cumulative rule. If you can remember that, you've pretty much mastered the numerator. Awesome. We've nailed the numerator. Now let's move on to the denominator. This is where things get really, really interesting with this whole concept of weighted averages. See, we don't just grab the number of shares at the end of the year. That wouldn't be fair. We use a weighted average. Think of it like this. A share that has been around for the entire year should count more than a share that was just issued last month. It just makes sense, right? So we weight each share based on how long it was actually outstanding during the year. As you can see in illustration 1, you can calculate it period by period, or you can do it by adjusting the opening balance. Both ways will get you to the same correct answer, which is 2,100 shares. Here's another really important point, especially for those questions where standards get mixed up. When you've got shares issued in an amalgamation, how you treat them depends on its nature. If it's a purchase, it's simple. You include the new shares starting from the date you bought the company. But if it's a merger, you have to treat it as if the two companies were always one. That means you include the shares right from the very beginning of the earliest period you're reporting on. Okay, 2 more quick rules for the denominator. First up, partly paid shares. Just think of it like this. You pay for half a share, you get half a share in the calculation. It's as simple as that, just like in illustration 2. Second, we have contingently issuable shares. These are basically if-then shares. They only get included in our calculation if all the conditions are met, and they only count from the date then onwards. Okay, everybody, really focus now. This is super important. We are now diving into the two areas that the ICAI just loves to test: bonus issues and rights issues. The most crucial thing to understand here is their retroactive effect, which, you might remember, brings us right back to that question I asked at the very beginning. And this right here explains it all perfectly. See, when a company does a bonus issue, they're essentially giving away shares for free. No new money is coming into the company. So, to keep things comparable, the standard says you have to adjust the number of shares as if those bonus shares had existed from day one. And what does that mean? It means a bonus issue in 2022 forces you to go back and restate the denominator for 2021's EPS. And there it is. That's the answer to our hook question. An event in 2022 can and does change your 2021 calculation.
Now, rights issues, they can look a bit intimidating, I know, but we can totally handle them. A rights issue is basically part cash issue, part bonus issue, because the price is usually a great deal compared to the market price. And it's that bonus element that triggers the same retroactive adjustment we just talked about. So here's the four-step process. First, figure out the new theoretical value per share. Second, calculate an adjustment factor. Third, use that factor to restate last year's EPS. And finally, for the current year, you apply that same factor to the period before the rights issue happened. It's a few steps, but just remember, it all comes down to adjusting for that hidden bonus element.
Perfect. We have now totally mastered basic EPS. So let's move on to the next level, what I like to call the what-if scenario of accounting: diluted EPS. This is where we have to deal with those shares in waiting we talked about earlier. So what is diluted EPS? Well, it answers a very specific question. What would our EPS look like if every single one of our convertible instruments actually converted into shares right now? It's a forward-looking, very conservative number. It's basically showing the existing shareholders the worst-case scenario of how much their piece of the profit pie could shrink or get diluted. To calculate diluted EPS, we have to adjust both the top and the bottom of our fraction. So let's start with the numerator, the earnings. It's logical, right? If you convert your debentures into shares, you no longer have to pay interest on them. So we add that interest savings back to our profit. But here's the key thing to remember. You only add back the after-tax interest. And the exact same logic applies to convertible preference shares. You add back the dividend that you would have saved. Now, the denominator adjustment is actually a little more straightforward. We just start with our weighted average shares from the basic EPS calculation. Then we simply add all the new shares that would be created if the conversion happened. And to show the maximum possible dilution, we make an assumption. We assume this conversion happened right at the start of the year or on the date the instrument was issued, if that was later. Let's quickly walk through illustration 5 together to see this in action. The basic EPS was $2. Now for diluted EPS. First, the profit. We add back the 12 lakh interest, but then we have to subtract the 3.6 lakh tax shield on it. That gives us an adjusted profit of 1 crore, 8 lakh, and $40,000. Next, the shares. We add the 10 lakh new shares from the conversion. So, what's our new diluted EPS? You got it, $1.81. You can literally see the dilution happening as the EPS drops from $2 all the way down to $1.81.
Okay, last one, share options. This is a bit of a special case, but the logic is actually pretty cool. So when employees exercise their options, the company gets a little bit of cash. The standard makes an assumption. It assumes the company takes that cash and immediately uses it to buy back its own shares from the market at the current fair value. Now, any shares that are left over, the ones the company couldn't buy back with that cash, are considered to be free shares, and it's those free shares that are dilutive and get added to our denominator. It all comes back to that bonus element.
Look at this scenario. A company has a net loss. It also has things like convertible debentures or options, what we call potential equity shares. Now, for calculating your diluted loss per share, what do? Do you add these shares in? And if you do, does that make the loss per share bigger or smaller? What's your gut feeling on this?
Now, if you're thinking, well, adding more shares would reduce the loss per share, so it's anti-dilutive, I should ignore them, then you've just walked straight into the trap. The real answer, the one that gets you the marks, hinges on one specific number that ICAI loves to tuck away in the question. And trust me, it's almost never the final net loss figure. Let's decode this. Okay, this first section, this is the absolute heart of AS20. If you can get your head around the real difference between dilutive and anti-dilutive, everything else will just click into place. We all know dilution means EPS goes down or loss per share goes up, but the test for it, well, that's where the secret lies.
Pay very close attention because this is where marks are won and lost. To decide if a potential share is dilutive, you do not look at the final net profit or loss. I'm going to say that again. You ignore the final net profit. The only number you care about, your one and only control factor, is the profit or loss from continuing ordinary activities. And you can bet that IKI will throw in discontinuing operations just to test if you know this rule.
This table basically sums it all up. A potential share is dilutive if and only if it makes the EPS from continuing operations go down or the loss per share from continuing operations go up. If it does either of those, you have to include it. If it does the opposite, if it makes the EPS go up or the LPS go down for continuing operations, then it's anti-dilutive and you throw it out. You ignore it completely for the calculation.
All right, let's circle back to that question from the start, which is pulled straight from illustration 7 in the material. So we've got a profit from continuing operations of $2,040,000. But then a huge loss from discontinuing ops gives us a total net loss of $120,000. We've got 1,000 existing shares and 200 potential ones just waiting.
So what's the rule again? We completely ignore that net loss of $120,000. Our control factor, the only number that matters for this test, is the $240,000 profit from continuing operations. Now, just think logically. You have a profit. If you increase the number of shares, what happens to the profit per share? Of course it goes down. And a decrease in EPS from continuing operations means the shares are dilutive. So we have to include them.
And this is the punchline. This is the whole trap in action. Because our control factor test told us the shares were dilutive, we must include them in our main calculation. So now we take the total net loss. Basic loss per share is the 1,020,000 loss over 1,000 shares, giving a loss of 120 per share. Diluted loss per share is that same loss over 1,200 shares, which is a loss of 100 per share. Now look closely. The loss per share actually went down from 120 to 100. It looks anti-dilutive in the final result, but it doesn't matter. The initial test on our control factor is what governs the decision. That is the key you cannot forget.
So, what if a company has a whole mix of things? Convertible bonds, stock options, the works. Well, you don't just throw them all into the calculation at once. You have to test each one separately. Then you rank them. You start with the one that's the most powerful diluter, add it in, recalculate your EPS, and then move to the next most dilutive, and so on. And how do you rank them? You calculate something called earnings per incremental share. The one with the lowest number is the most dilutive, and it gets to go first.
Okay, you'll want to star this in your notes because this is a guaranteed 5-mark theory question. What's the difference between a bonus issue and an issue at market price? Think of it like this. A bonus issue is like taking a pizza and just cutting it into more slices. The pizza itself didn't get any bigger, right? No new resources came in. Because of that, you have to go back and adjust the EPS for all prior years as if those extra slices were always there. That's retrospective adjustment. But an issue at market price, that's like getting a whole new pizza delivered. New resources came in, so you only start counting those shares from the day they arrive, using a time-weighted average.
You can do all the calculations perfectly, but if you don't present the answer correctly, you're just throwing away marks. So let's quickly go over the exact presentation and disclosure rules to make sure you get every single point you deserve.
First up, presentation. The standard is crystal clear on this. Basic and diluted EPS have to be right there on the face of the statement of P&L, not buried in some note. If you have different types of shares, you need an EPS for each, and you show it for the current year and all comparative years with equal importance. And please remember this. Even if the company makes a loss, you must show the negative EPS, the loss per share. You can't just skip it.
Next up, the disclosures and the notes. Think of this as showing your work. You have to disclose the numerator, your earnings figure, and show how it reconciles to the net profit. You do the exact same thing for the denominator, the number of shares, and show how you got to the basic and diluted figures. You also need to show the EPS without any extraordinary items. And one last easy mark to get, just disclose the nominal value of the shares.
Good. MCQs are one thing, but let's dig into the theory a little bit deeper. These are the why questions that really show the examiner you understand the concepts, not just the formulas. Question 6 asks a really important practical question. From which date do we start counting new shares? The logic is simple. It's the date the company gets the benefit. So for a cash issue, it's when the cash is receivable. For debt being converted, it's the date of conversion. For services, it's when the work is done. It just makes sense. The question also asks for a definition. A potential equity share is just any financial instrument that might give the holder equity shares in the future. Questions 7 and 8 are perfect for reinforcing two of our key concepts. Question 7 on stock options makes it clear. It doesn't matter if an option is vested or not. If it exists and is dilutive, you have to include it for the period it was outstanding. And question 8 is our pizza analogy all over again. Bonus issue means no new money, so we restate the past. A market price issue brings in cash, so we only count it from the date it happens.
And here we go. This is the main event. It's time to take all this theory, all these rules, and apply them to full-fledged exam-style practical problems. This is where we put it all together.
Here's a quick roadmap of what these problems will test. Question 9 is tricky. It combines a bonus issue and a fresh issue in the same year, so you have to handle both retrospective and time-weighted calculations. Questions 10 and 13 are all about rights issues, which means we have to nail that special adjustment factor. Question 11 focuses on partly paid shares, and question 12 is your bread-and-butter convertible debentures problem, where you have to adjust both the earnings and the number of shares.
Let's just focus on that rights issue for a second, because it can be tricky. A rights issue is basically part fresh issue and part bonus issue, because the shares are offered at a discount. To deal with that bonus element, we calculate this adjustment factor. The formula looks complex, but all it's doing is comparing the share's value right before the issue to its theoretical value right after. You use this factor to adjust the prior period's EPS to make it comparable to this year's.
And that's our complete tour of AS20. I'll leave you with one final question to make sure this all sticks. If a company has both convertible preference shares and convertible debentures, in what order do you test them? The answer, of course, goes right back to what we learned. You have to rank them. You calculate the incremental earnings per share for each, and you start with the one that is the most dilutive. If you understand that one core principle of ranking, you have truly mastered the logic of this standard. All the very best for your exams.